Hey, this is J.R. St. Julien with the St. Julien Real Estate Group of EXP Realty, and welcome to my March 2022 market update, where we're going to talk all about how the Fed's response to high inflation will impact the current San Diego market. Stay tuned. So nothing much has changed as far as what we're seeing in the actual housing market itself, outside of one thing: interest rates. And interest rates right now are totally being driven by inflation. So we're gonna dig into that, but before we get into that, let me just give you some basics of what we're seeing right now. This is based on February's numbers, where we're still seeing inventory in the toilet. We're down 45% year over year, so it's worse than it was last year at this time. And we're seeing prices appreciate, just like we saw them appreciate in 2021. So basically 2022 is starting off just like 2021 did, which is a surprise to many. And I would say it's even a surprise to me. I expected appreciation to continue and competition to still be fierce. I didn't expect the fierceness of 2021 to return to this market. But that being said, let's get into what's really going on behind the scenes and how that could potentially change the market going forward. So as we all know, the Fed just met. They just increased their Fed funds rate by a quarter basis point. What does that mean? They increased the rate that banks can borrow funds from each other by 0.25%. Not a huge increase, but it's perfectly in line with what everybody expected the Fed will do. Additionally, they said they would slow their quantitative easing, which equates to purchasing of mortgage-backed securities with respect to the mortgage market. Obviously, they also purchase other types of bonds, but mortgage-backed securities are a large portion of what they purchase in their quantitative easing program. And they've indicated that they will continue to raise rates at future Fed meetings throughout the rest of this year. So what does that mean? Well, in response to the upcoming rate, so that means between January and March, kind of in anticipation of this meeting, the interest rates have rose and are now sitting right around 4.75%. Now that's the highest we've seen since 2018. In 2018, we hit just about 5% in November 2018, and that's the highest rate we've seen in quite some time. Now, as I mentioned, this rate rise was kind of in preparation for this meeting. Now, post-meeting, the rates haven't drastically shifted much, but because of the Fed statements and the expectation that they will continue to reduce the amount of mortgage-backed securities that they're purchasing and to increase their interest rate going forward, indirectly, the mortgage interest rates will continue to go up. Now, they don't go up a quarter point for a quarter point based on a Fed interest rate increase, but they do go up based on the culmination of all of their activities. Now, all of these activities are really focused on curing inflation. And if you go back and look at history, you'll see that the last time we had inflation rates above 7% was between 1965 and 1982. And that was the era of great inflation. Simultaneously, during that time frame, we saw mortgage rates get as high as 18.5% and inflation get as high as almost 15%. Now, I'm not saying that we expect to see those type of numbers right now, because I do believe that the Fed has learned how to better control inflation and has improved its monetary policy since 1982. But this is the last time that we saw something similar happen. And the direct connection between inflation and higher mortgage interest rates is real and can't be denied. So what to expect going forward? Well, we expect the mortgage rates to continue to increase. How high they're going to get, to be honest, I don't know. I would expect we probably will be seeing interest rates in the 5s in a not too distant future, which historically is still a fairly decent interest rate. It's just a really crappy interest rate compared to the 2.7s and the 2.5s that we've seen in the last year. So how will that impact the housing market? Well, if you go back and look at when did we actually have inventory to buy in this housing market, you'll see that there was a steep decline in inventory back in 2019. And that steep decline kind of corresponded with us peaking at that 5% interest rate at the end of 2018, and then us slowly running down to the lowest of the low interest rates that we hit in the last year. So that decline of interest rates also seemed to correlate with the decline of inventory. Just in 2019 alone, inventory was cut in half. And pretty much since then, inventory has just about been cut in half every year going forward. Now, obviously, we've had a pandemic that played a role in this, but I do believe the combination of very low interest rates, the fact that people tend to stay in their homes longer now than they did, say, a decade ago. I think the average now is about 13 years. I think those combined with the uncertainty in the world are just making people want to stay put. Despite all of this stuff that's going on with the interest rates and despite all the stuff that's going on with the inflation, I'm not seeing anything that's going to drastically change the inventory levels. And that's the major thing that's behind the competitive nature and the rapid appreciation in this market. So what I am expecting is that the rising interest rates will cut people out of this market. I'm not expecting a drop in home prices, but I am expecting fewer folks to be able to afford to buy, especially in San Diego's market, due to the increased monthly payment cost of that home at that particular price when the interest rates go up. I think I mentioned this before, but a 1% increase in an interest rate typically results in about an 11% decrease in someone's purchasing power. So when you combine those two together, it stands to reason that as the interest rates increase, the demand for housing has to go down. Now, the big question is, will the decrease in demand be adequate to allow the inventory to build up to allow us to get back to some sort of a balanced market? I don't believe that's going to happen, but we'll stand to see, because we have a long way to go with respect to inventory, and we still have a very high demand despite this uptick in interest rates that we've seen this year. I've seen no impact on the demand just yet, so we just got to wait to see how long will it take for those higher interest rates to start to actually have a noticeable effect on demand. So, moral of the story is, expect interest rates to go higher. Expect the cost of homes to get higher. If you're thinking about buying a home and that's something that you want to do, but you're thinking, hey, I should wait because I think the home price is going to go down, I would caution you against that. I think the combination of inflation is going to result in higher interest rates, and those higher interest rates will cause the cost of the home to cost more to you. Even if there's a 10% price reduction in that home, a 1% interest rate increase will offset that price reduction. So, if you want to buy a home and you're capable of buying a home, don't wait. Get in the market now. It's a great hedge against inflation. And as long as you're going to be there for the next 5 to 10 years, I don't think there's anything to worry about when it comes to what's going to happen with this market. On the flip side, if you're thinking about selling a home, I think that this extreme seller's market that we're in right now will peak at some point in the near future. It just really has to, because eventually the interest rates are going to start to wean off some of that demand, which will slow the extremeness of the seller's market. Now, that being said, it will remain a seller's market for a while, in my opinion, but now may be one of the best times to sell, especially as we get into the spring and the summer season. So if that's something you're thinking about doing, I would highly recommend you give me a call. We could talk about the strategies to get you the most amount of money out of your home. And if you're worried about trying to figure out how do I sell and buy in this market, we have some great strategies to help you with that, whether it's a home trade-in program, a cash for your home program. There's lots of options out there in the marketplace. So call me, we'll figure out what you need and find the best option for you. Regardless, if you're thinking about buying or selling, I'm here to help, and I would love to talk to you about this market in more detail, specifically about your needs and what I can do to be of service to you. So again, I'm J.R. St. Julien with the St. Julien Real Estate Group, and thank you for watching this video. Please don't forget to subscribe, give me a thumbs up if you like it, and feel free to follow me on Instagram at J.R. St. Julien. Hope to see you there. Take care.